And in a week where yet again market hopes are high for a breakthrough in Europe, we've brought in a second global advisor, this time on the debt side. PIMCO is a global investment management firm and in Australia manages more than $30 billion in fixed income funds. Scott Mather, head of global portfolio management for PIMCO, was in Sydney today to talk about the global economic outlook. Scott Mather, welcome to Late Line Business.
Thank you.
Well, here we are, a very big week in Europe. You used to lead portfolio management for PIMCO in Europe. How likely do you believe a solution is on Wednesday?
Well, we think it's unlikely to be the solution. There's high expectations that there's sort of incremental progress made on many different fronts, and we think that's built into the markets. There's a good chance for some disappointment on Wednesday.
If we do get that disappointment, I mean, every week we go on, we've got these volatile markets sort of hoping and trusting and believing that the politicians will actually solve something, and then down again. How long can markets live on hope like this?
Well, they'll certainly move back between fits of hope and despair in this environment, because the fact is there isn't one answer, there isn't one simple step that can really move the needle.
But there's not a point where they'll suddenly decide, well, that's it, we're going down.
Well, we've had many of those points already, and we think it's likely we'll see some more.
It seems like some sort of haircut, significant haircut, perhaps 50% maybe on Greece will actually happen. To what extent could PIMCO be impacted by that?
Well, directly we wouldn't be impacted. We've been underinvested, basically not invested in Greece and many of the other problemed peripheral countries. So no direct impact, but certainly there is an impact, or will be an impact, on all financial markets, depending on how that haircut is received. But at this point,
the contagion, I suppose.
But one thing we would focus on with respect to the haircuts in Greece, I mean, where the Greek debt is held is largely contained within the European banking system. So by this point, everyone knows who owns it. And they also know what it's worth, because we observe the market price, which is already well below 50 cents. So in reality, it shouldn't be any big surprise. And if it happens on Wednesday or it happens 2 months from now, we would say it's inevitable.
Now, your founder, Bill Gross, was recently picked up on his comments back in 2008 that there was close to 100% probability that Lehman would avoid failure. He's just recently sent out a mea culpa letter to investors for a bad year, an apology. PIMCO is now reportedly going to go heavily into mortgage-backed securities. Why are you doing that?
Well, we've been talking about a lower growth and lower inflation forecast for the U.S., and that's very supportive for high-quality bond prices. Yes, treasuries. Yes, also mortgage-backed securities. And mortgage-backed securities benefit from having a high amount of support from the sovereign. It's implicit, it's not explicit. But when we look at those relative to treasuries, they seem quite attractive. They offer an additional yield cushion. We also think that it's likely that policymakers, if there is another step towards quantitative easing number 3, that mortgage-backed securities might be one of the targeted assets that the Federal Reserve would seek to purchase to really try to bring down mortgage yields and mortgage rates for the average homeowner in the U.S.
Because mid-year PIMCO was talking about a new normal, but even those quite conservative figures, I think you were talking about 2% growth, 2% inflation, that looks quite out there now.
Yes, it turned out, our new normal was a well below consensus forecast at the time, and it turns out that that's even been too optimistic. And so recently we've revised down our forecast even further for developed world growth for next year, closer to 0.
How much of that has got to do with the China growth story? I'm asking a lot of people that come in now about whether the great story that we were hearing at the beginning of the year is still consistent.
Yeah, well, we think that China hasn't been so much the cause of the developed world slowdown, but it can't escape the impact of having less external demand. And certainly, in our view, it's the rest of the world, for the most part, weighing upon Chinese growth, rather than China driving the developed world into slower growth territory.
And what about the internal concerns in China, the shadow financing, the property bubble, and the fact that a lot of people are concerned that some of these figures just don't add up?
Right. Well, there's certainly a lot of problems within China. You've just gone through a list of them that people are most concerned about. It's right to be concerned about those, but we think people are not necessarily looking at the large amount of flexibility that China has. The very large and for the most part, relatively sound balance sheet that they have, the high amount of official reserves. So they have the ability to respond. They have policy flexibility to start addressing some of these problems. So we don't think that the problems are going to spin out of control and drag China down, in the way that some people seem to believe will happen.
Thank you very much for coming in, Scott Mather.
You're very welcome. Thank you.